While US dollar interest rates have been on an uptrend so far this year, Sing dollar interest rates have outperformed. The increases in Sing dollar interest rates were more muted. Looking ahead, we expect some upward normalization in Sing dollar interest rates. There has been some decoupling between Sing dollar interest rates and US dollar interest rates performances. Sing dollar liquidity has been supportive for most of the time, anchoring short-end Sing dollar interest rates. Sing dollar fixed income assets have benefited from safe haven flows, which also helped mitigate the upward pressure on bond yields. These dynamics resulted in deeply negative Sing dollar US dollar interest rate differentials. There were some days when Sing dollar liquidity did tighten. SORA, the overnight rate, has been volatile and is likely to remain so. In the first half of this year, SORA fluctuated in a wide range of 0.76% to 1.46%. That was a 70 basis point range. Our medium-term forecast assumes some upward adjustment in Sing dollar interest rate. First, although the connection between Sing dollar interest rates and the economic fundamentals has not been particularly strong, a wide deviation may not be sustained. OCBC economists forecast Singapore GDP growth at above 4% this year and inflation at above 2% this year. A short-end interest rate level that is below 1.5% and long-term interest rate level that is below 2% appear overly stimulative. Second, Sing dollar rates are significantly below US dollar rates. For example, the gap is around 200 basis points for the 2-year tenor. There may be some normalization to the spreads as well. Third, if there is no further liquidity injection from FX interventions, then liquidity in the system may become less flush over time. We expect SORA to edge higher to fluctuate nearer the 1.4% level rather than hovering below the 1% level. On balance, in the scenario where interest rates go higher, the upside appears to be bigger than when interest rates go lower. For hedging purposes, given the negative carry to start with, it is not an easy decision. But given the uncertain interest rates outlook with risk of higher Sing dollar interest rates, corporates may still consider partially locking in their funding costs. Elsewhere, in China, we look for a bottoming out in renminbi interest rates. A 10 basis point PBOC rate cut is already in the price, while the reflation narrative may finally gain some traction. In Hong Kong dollar space, we expect sporadic jumps in Hong Kong dollar interest rates, especially upon seasonal flows. But after interim interest rate jumps, Hong Kong dollar US dollar rate spreads are likely to revert to ranges. Investors may also want to be watchful for any liquidity implications if there is FX intervention when spot touches either 785 or 775. Korea Treasury bonds may be able to garner some support from index inclusion flows, while the yield pickup is favorable. Malaysia government securities may maintain their relative stability, while Indonesia government bonds may potentially stabilize if investors' confidence does not worsen from here. Granted, there are always two-way risks to the interest rates outlook. Sing dollar liquidity may stay supportive. The loan-to-deposit ratio is relatively low, while SGS, Singapore government securities, being AAA rated, may continue to benefit from safe haven flows. In addition, local Asian markets are affected to various extents by the volatilities in the global markets.